Whether you're an established business owner or a startup, at some point you may need to consider having to raise money, whether it be to take on new premises, buy new equipment or help to develop a new product, for example. We're now going to explore the different options available and the associated pros and cons. So what are the possible options and what needs to be considered?
You need to consider why you need the financing and how much you would need and when you would need it by. There are a number of sources of financing and there are pros and cons attached to all of those.
Would you need to have a business plan?
Yes, a business plan is essential. It's an active document and it will show future investors what they will be investing into, and it will give you ideas of how much funding you will need and when you will need it.
Are there any options to consider before turning to external sources?
Yes, you could always look at your own cash reserves and the investments that you have and possibly sale of assets.
There must be some significant advantages to this.
There are. The profits are retained in the business and you keep control. And it shows commitment to an investor should you need further financing.
So there are advantages, but what are the risks?
The risks are the cash is already tied up should the business hit a rough patch. And if the loan was taken out against an asset such as a house, it is at risk if you don't keep up the loan repayments.
So we can now move on to explore the external options. So what is debt finance?
Debt finance are loans and overdrafts. The lender will expect the loan to be repaid and there will be conditions applied to the loan.
What about borrowing money from friends and family?
Friends and family are an option, but to avoid misunderstanding, it is best to have a formal agreement.
What about borrowing from a more formal lender, such as a bank?
When you borrow from a bank, there are fixed monthly payments with interest charges, and the loan is over a fixed term, but you have to ensure that you don't breach the terms of the loan.
Any disadvantages with this type of finance?
Yes, you may well have been asked to put either business or personal assets as security against the loan, which could be at risk.
What about equity finance? What can you tell me about that?
If you're willing to give up a share of the business, it is an option. The investor will require a degree of control over the business and possibly dividend payments.
Keeping with the equity finance theme, what can you tell me about business angels?
Business angels usually invest in high growth businesses. They will require share equity and they typically invest between £10,000 and £750,000 in those businesses.
What about venture capitalists or VCs?
Venture capitalists normally look for businesses that require at least £2 million in investment, and that means that they're looking for proven track records and therefore unlikely to consider startups.
What about setting up a joint venture or a partnership with another business?
That's a very good way of pooling your resources to enable the business to grow. It is very important that you look for a complementary business that adds value to both yours and to theirs. Also, look at the culture of the business and building the relationship and developing the trust with them.
Once you've found a partner, what next?
It's very important to get a legal agreement in place that sets out the terms and conditions of the arrangement, and that's best done through a lawyer.
We've looked at debt and equity finance where the investor has an expectation of return upon their investment. What other options are there?
Grants could be an option. There are advantages and disadvantages to them. The advantage being that you do not have to repay the grant and they wouldn't expect equity share in the business. The disadvantage being that the competition is fierce for these grants, the eligibility is very stringent, And should you not adhere to the terms and conditions, it may be that you have to pay the full grant back.
What can a business do to improve its chances of raising finance?
Key to this is good preparation and a solid business plan. After all, you need to convince someone to invest in your business.